folks. Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory. Thought we'd come to you today with a brief market update focused on the election and in particular the election results. So S&P 500 right at around 59.46 as a level. That is up about 26% year to date. Obviously, large cap stocks having a phenomenal year and responding very, very well to the news that the Republicans will take control of the executive branch as well as the Senate and most likely the House. So we thought we'd come to you today with a little bit of a view of, how does that play out over the next 2 to 4 years, as well as some of the sort of policy implications of a Republican-controlled government, or at least anticipated policy implications as they relate to economic growth in the overall market. So we will jump right in. And the first thing that I think it's very important to understand is Trump 2.0 is likely to look a little bit different than Trump 1.0. He is coming into the office having won about 51% of the popular vote. That is the first time since 2004, so he's likely to feel emboldened. First time since 2004 that the Republican has actually won the popular vote. That's likely to kind of embolden him, and he is likely to also have majorities in both the House and the Senate. And if you think about the first Trump administration, President Trump was largely an outsider, even within his own party. In his first administration, there were many Republicans that were not on board with the Trump train. He was a surprise. And so you had people in the legislature, in the House and the Senate, in his own party that were kind of willing to stand up to him, willing to oppose him. You had sort of established leaders within the sort of bureaucracy of the executive branch that were also, I think, maybe thinking about stymieing him along the way. If you think about the second Trump administration, that is largely not the case. There's a significant Trump is very clearly the leader of the Republican Party. There's a significant portion of the Senate and Congress that are actually pro-Trump in his camp, leaning Trump. And perhaps more importantly, when we think about the Senate and the House, both of those institutions, Trump has demonstrated that if you do not support him, that he, can make life politically difficult for you, even if you're in his party. And so the likelihood that you're going to get any type of opposition to his policies from rank and file Republicans seems much lower now than it did in his first administration. At the same time, Trump at this point has had or will have a lot more time to prepare to take office. There are a lot more Trump loyalists that have been vetted in terms of, their ability to take on secretarial positions, cabinet positions. And so the sort of chaos that you saw throughout the first Trump administration in terms of people being appointed to positions and then subsequently being removed when maybe they didn't quite agree with Trump on a particular issue, you're likely to see a lot less of that this go around because there are just a lot more people out there that have been vetted, that are loyal, et cetera. It means that Trump, both of these things mean that Trump is likely to be a little bit more effective in his second term than he was in his first in terms of getting through his policies. And so with that, we'll turn to what those policies actually are. And we'll separate them into the sort of pro-growth policies, pro-market policies, and then maybe some that are a little bit, that the market might frown on or that might be a little bit negative for growth. In the pro-growth camp, it is highly likely that Trump will push for sort of full extension of the Trump tax cuts. He's obviously the one that passed these in the first place. He has campaigned on the idea of extending all of them and maybe even minorly, expanding some of them, expanding a little bit of the federal income tax on a personal level. Reducing a little bit of federal income tax at a personal level, certainly extending the corporate tax cuts, et cetera. That is a positive for growth, particularly when you compare it to the alternative. And so, I expect that he's probably going to get very little opposition from that. The second thing thing that I would say that we probably will see is a little bit of an expansion of federal spending, particularly on defense. This is particularly true for most Republican administrations, that we see a little bit of ramp up in defense spending. This doesn't necessarily mean that we know exactly what direction it's going to go in. So, if you think about Israel versus the Ukraine, those things are still toss-ups. But if you think about just overall defense spending, that is likely to go up. And then last but not least, in the pro-growth camp, you have, pretty significant impetus for lower regulation, less red tape, deregulation of certain industries that are highly regulated. In particular, if you think about utilities, if you think about energy, if you think about banking, you think about all of these sectors where the government tends to get its hands into. The Trump administration, if they follow, previous precedent, will look to, give them a little bit more free rein to do business. And all of those fall into the sort of pro-growth camp. It is one of the reasons why when you look at the S&P 500 reaction yesterday, to the market when it was, up large. If you look at the reaction of banks or energy companies, they also rallied sharply. Small cap companies that benefit from deregulation, all of those sectors were, reacting very, very positively. If you think about areas that might be a little bit negative for growth, first and foremost, import tariffs. Trump has campaigned on, pretty large tariffs against China and, sizable tariffs potentially against the rest of the world as well. That's inflationary. If we are importing steel into this country and all of a sudden steel becomes 20 or 30% more expensive to import, domestic manufacturers typically raise their prices to match the import price. That's the market clearing price. Domestic manufacturers get to live within that. As a result, that's one of the reasons why domestic manufacturers like it so much. But for the average consumer, it's currently estimated that if Trump went through with all of the tariffs that he's mentioned on the campaign trail, that it would raise inflation by a one-time amount of about 30 to 40 basis points. So 0.3 to 0.4% increase in inflation. To put it into dollar terms, that's about $1,500 per household in the United States in terms of increased costs for the stuff you normally buy. That obviously, anytime you get a price raise on that, it slows down growth. And the other thing that that's going to do is it's going to confuse the Fed a little bit. When they see inflation, they're not going to know exactly how much of that is due to, the tariffs versus due to the economy heating up a little bit. That may put the Fed a little bit on hold or cautious in terms of the way in which they reduce rates going forward. Which actually has the effect of interest rates likely to stay a little bit higher for longer, in addition to increased costs across the supply chain, for other for other companies and for consumers. Second thing that I would say in the sort of somewhat negative for growth camp is continuation of concurrent deficit levels, maybe even some expansion of current deficit levels. That puts pressure on treasuries, which generally means that the long end of the curve, sort of comes up. We certainly saw that post-election, that interest rates on the long end of the curve rose. Anytime we see interest rates rise, that means higher borrowing costs, and that impacts businesses. It impacts things that consumers finance, such as automobiles and homes. And so that's a potential drag on the economy as a result of, increased deficits, as well as the point we mentioned before, the Fed being potentially on pause for a little bit longer. And then last but not least, and this is, certainly a politically sensitive topic, I will note that, if you think about gross domestic product, if you think about overall economic growth, it can really be broken down into the average amount of stuff that each worker makes in the United States times the total number of workers there are. And so anytime we see population within a country, that growth slow down, or we see that population growth actually decline temporarily, it actually generally translates to a slowing or a decline in GDP. And you can see this across Japan, all of Western Europe, as all of these countries' population growth rates have slowed. They have noticed, slowing GDP growth rates because, once again, the more workers you have, the more people you have to make stuff, the more stuff that's made. Which brings me to the point of if you are serious about dramatically lowering the amount of immigration, whether that immigration is legal or illegal, it will have an impact on our potential GDP growth rate. So we would put that into the sort of, somewhat negative camp in terms of overall GDP growth that we can achieve. You net it all out, there are very clearly winners and losers. You can look at the trading activity immediately post, the election day and see those sectors pretty clearly. As we mentioned, things like small cap companies, banks, utilities, energy companies all having really great days. Things like retailers who are dependent on imports largely for their cost of goods, not having such a great day. And certainly, bonds, foreign equities, et cetera, not having the best day as well, based on those sort of domestic interest rate movements. Long story short, it's going to be a very interesting next 4 years. We're not exactly sure what policies are going to go into effect, but we do know who's going to set them, and that information is very valuable. So we will sort of strap in and see what the next 4 years hold. As always, if you have any questions, feel free to reach out to myself or to your advisor. I look forward to talking to you again soon, and I hope you're having a great day.